This special podcast is brought to you by Futuregrowth Asset Management, and today I'm talking to Jason Lightfoot, who is the portfolio manager of the Infrastructure and Development Bond Fund. And specifically what we'd like to talk about today is infrastructure spending in South Africa in the context of retirement funds. Jason, explain to us what infrastructure spending actually is.
Thanks, Candice. So, the government launched a national infrastructure plan back in 2012, where they set up various objectives in terms of what's required to fund the infrastructure spend across the country over the next couple of years. Those are things like toll roads, rail and port, things like aging water infrastructure. But obviously the whole idea is that government can't fund those objectives by themselves, and the idea is that they need to bring the private sector on board as well.
So in bringing the private sector on board, they'd obviously need to make these projects attractive enough from a return perspective for private sector to actually want to put their funding anywhere near it.
Correct. So obviously private sector can play two roles, either by providing debt in the form of loans, or actually providing equity. Now, equity primarily in the form of PPPs and the like.
Sorry, what is a PPP?
So it's public-private partnerships.
Okay, great. So would Eskom, the spending that Eskom requires, form part of the infrastructure spend, which is the government's remit?
Correct. And the likes of Transnet as well. The traditional ports of call, where those sort of entities raise their funding from, would be in the form of listed bonds. Eskom and Transnet have a lot of listed bonds in terms of listed on the JSE, where a lot of pension funds obviously purchase and obviously tap into that requirement. So from a risk-return point of view, it's quite important that the underlying analyst who looks at a particular transaction is able to commercially price for the particular risks that are embedded in that particular transaction.
What would the risks be in a transaction typically? What are you looking for?
So obviously the biggest risk in any sort of transaction is the risk of non-payment. So what's the eventual probability of default of a particular transaction, and ultimately that results in you assigning a credit rating to a particular deal, and that will feed back into in terms of what that particular borrower needs to pay up from a rate point of view.
So most of the infrastructure spend is obviously unlisted. Does that make it more or less risky?
Well, not really. There's quite a large amount that's still tapped via the traditional avenues, via the listed market, the Transnets, the Escoms. But the bigger picture, there are quite a lot that still rely on the unlisted markets. Renewable energy is obviously at the forefront of everyone's minds at the moment, and the bulk of that is being tapped via the unlisted markets, primarily through the banks, which then syndicate to asset managers like ourselves.
And then in the terms of retirement funds who are now able through Regulation 28 to invest in some of these infrastructure spends, which part of the retirement fund does this cover, and then what kind of returns are we looking at?
Yeah, so as I mentioned earlier, there's probably two avenues really, from a debt point of view in your traditional bond funds, or maybe not so traditional bond funds, or potentially in your private equity funds. Okay. So obviously it's depending again on your underlying level of risk or assumed level of appetite for risk from your particular pension fund, which will then obviously feed into what your expected return might be on a particular transaction or a particular portfolio of transactions.
And do the yields from these transactions, are they far superior to government debt?
Yeah, government debt in most instances is your base rate really. So you're expecting to return or expecting to earn a rate above government for that additional risk that you are taking, because governments are deemed AAA in a South African context. So anything that you invest in below that would need to earn a rate obviously above that based on where you're funding it.
And in the context of actual portfolio management, these are long-term projects. When you include them in your portfolio, how do you view them in the context of your asset allocation?
So obviously for a typical pension fund, a typical infrastructure asset is quite long-term in nature, and pension funds have quite long-term liabilities. So in essence, it's really a perfect match for those types of investors.
And how do you deal with liquidity?
So liquidity in a fund like this, I mean, we manage the Infrastructure Development Bond Fund, so we build in various measures of liquidity where we have to have a certain amount invested in liquid assets, which might be a combination of listed government bonds or purely money market assets, which mature quite soon. So you can actually ensure that there is a level of liquidity in the fund to meet withdrawals and the like.
Okay, and then if we take a kind of step back from a global perspective, China must be the kind of pin-up child of infrastructure investing, whichever way you look at it. And they have done large amounts of spending. How does that compare to what South Africa's done, and then how does South Africa compare to other emerging markets?
Yeah, I mean, South Africa definitely hasn't touched the top of the iceberg. I mean, if you look at China as an example, that economy's grown 7 times over the last couple of years. And that's primarily off the back of that massive injection of investment in infrastructure assets. South Africa really isn't quite where it should be. There's a measure that we look at where it's about 15% of GDP, if I remember correctly. So really it needs to get up to probably in the 30% or so to make any sort of impact in terms of growth and in terms of its impact on GDP going forward.
And does the National Infrastructure Plan give you any comfort that the intention or the appetite is there from government's perspective to increase to the levels that it's needed to?
I think it's a good measure that government's put in place, because it's identifying, these are the shortages, these are the issues that need to be addressed, and they are creating the right forums in respect of the Presidential Infrastructure Coordinating Committee to take things forward and address the shortages within the country. But I guess it's a dialogue that needs to be had with with the private sector at the same time to see where can you fit in, what assistance can you provide to these projects.
And is that dialogue open? Does government consult with private sector on these kind of requirements?
It definitely does happen. It happens primarily through a CISA.
Okay.
And obviously we get our feedback through that organisation.
Jason, so is what you're telling me that the large majority of the fund that you run, the Infrastructure and Development Bond Fund, mainly invested in government infrastructure spending projects?
No, it's actually across a whole lot of different projects as well. The fund's been in existence for the last 15 years or so, funding various projects ranging from developmental type assets like funding SME businesses, providing finance to taxi drivers, to in fact things like chicken farms. And it's been doing that for the last 15 years. It's currently about 10 billion rand in terms of its assets under management, and outperforming the benchmark of the All Bond Index by probably at least 2.5% over the last 15 years.
That's a fantastic return and a huge size. Congratulations.
Right, thank you.